right, welcome back to this next episode of Asset Coach and Tax Strategist. And so we're going to take a little step away from California and China and talking about all that fun and exciting stuff of de-dollarization and China's economy dropping and people leaving California. Now let's talk about something that's real to all of us here in the United States is the IRS and the changes and the adjustments that the IRS is trying to make and some of the confusing conversations that they're saying. Now, you may not know this is happening, right? We have busy lives, we're doing our thing and we're running our businesses or whatever the case may be. Kids are going back to school and summer vacation's over. We're all getting into our normal routine. But what is happening is a lot of background conversation about, hey, the IRS is all caught up and, we're going to make changes and the new funding of the IRS of the $80 billion. What's it going to look like? They swore in a new commissioner this year. You may not know that. And so all this stuff is happening. And Janet Yellen is the Secretary of Treasury is going around and having all these conversations and talking about what they're going to do to go take more taxes. All right. And so I'm going to read through an article, but we're going to do some education here. Okay. So because some of this is we need to understand the education of the system that's been designed and developed that now the current Secretary of the Treasury wants to slap everybody on the hand and say, you can't do this. This is ours, meaning the taxes are ours. It's our money and you're not allowed to do this, even though people are playing by the rules. And when people play by the rules and the IRS and the government doesn't like it, they call it loopholes. And they call them loopholes that they've known that have been there for a long time because they've developed these laws and they've developed these rules for us to abide by. And people abide by the rules. And then when the IRS sits there and the government sits there and says, hey, you're not paying enough taxes, they call it a loophole. The problem is the tax industry, meaning CPAs and tax planning firms and you and I as taxpayers, we call them loopholes as well. So we're using their language and we need to stop because these aren't loopholes. These are the rules. You're playing by the rules. Now, I'm not going to profess that I am the ultimate authority to the IRS and the rules and what's out there. I'm just going to share what my understanding is. I'm going to share a couple resources meaning a main article from Epoch Times. And this article this topic is not just by Epoch Times. This has been in a few different areas, including Secretary of Treasury Janet Yellen. When she came out and swore in the new IRS commissioner, she has also said these things. So where mainstream media may not be reporting on this, it is being reported. The other resource I'm going to use is the Securities Exchange Commission, which talks about a term called accredited investor. And we're going to go through that. And that's part of the rules of the structuring of how they set things up. And then the last thing is we're going to define partnerships, because this whole article and all of this hoopla is about what they call complex businesses, really around this rule of being a partnership. It's a pass-through entity. So let's go through and let's start with the partnership first. Okay. So I'm going to go ahead and share my screen so you can see what this article is. Let's see here. Okay. So I Googled right here. You can see at the top partnerships. And the first thing that pops up is who? The IRS. Okay. A partnership is a relationship between two or more people to do trade or business. All right. Each person contributes money, property, labor, or skill and shares in the profits and losses of the business. It's called a pass-through. So whatever at the end of the financial period, and usually these are a 12/31 calendar year, at the end of 12/31, the accountants, the bookkeeping will all be calculated based on accounting guidelines. And at the end, we'll say profit or it'll say loss. Whatever it says, it'll pass through. The IRS tax form is a 1065, and it'll pass through that profit or loss based on the percentage of each partner owns. So if I own 5% of the partnership, I'm going to get 5% of the profit, or I'm going to get 5% of the loss. That goes onto my personal tax return, the 1040. It goes on Schedule E, Part 2 or Page 2, and it flows to Schedule 1. It flows to the very first page of the tax return, the 1040 personal tax return. In fact, the IRS has an entire publication called 541 Partnerships, and it explains how to form a partnership. So let's click here. Here we go. IRS website. Okay, we're an official website of the United States government, IRS website. And it highlights exactly what we just got done reading. Okay, so it talks about right here, a partnership must file an annual information return to report the income, deductions, gains, losses, etc. from its operations. But it does not pay income tax. The IRS highlights that in bold. It does not pay income tax. Instead, it passes through profits or losses to its partners. Each partner reports their share of partnership income or loss on their personal tax return. Okay? Partners are not employees and shouldn't be issued a W-2. The partnership must furnish a Schedule K-1 on the Form 1065, which I just explained. What is a K-1? It's like a W-2. It just lays out what the partnership profit or loss and the percentage, the person's name or the entity's name, the tax ID, all the IRS and governmental information necessary for who to track, the IRS. Very simple. It's a great rule. It's a great structure. Makes a lot of sense. Okay. Now, we could go all the way through publication 541 if you'd like, and go through all of these explanations of withholdings and all this fun stuff, but we don't need to. Forming a partnership and how it's organized and classified, and you can have an LLC as a partnership, which is called a multi-member LLC. You can go all the way through it. We can do all that. Okay, it's like, I don't know, I think it's like 32 pages when you print it out. We can do that if you'd like. And the interesting thing is that this is the IRS website. These are the rules. This is what the accounting firms, bookkeepers, tax professionals are all talk about right here. They even talk about how to terminate a partnership, and they explain how to do it. The date of termination, the short period return, conversion of partnership into an LLC, electronic filing, exclusion from a partnership rules. They go into that. Okay. I mean, it literally distributions, how to distribute. It goes all the way through all the rules. Okay. So if you are somebody who's so inclined to want to follow up and find out about all this, you're welcome to do so. Nothing is holding you back. But at the end of the day, IRS website. All right. Now let's talk about an accredited investor. And I apologize for all this education here, but knowledge is power. And it's just not knowledge that's power. You can't just sit there on this information. You got to implement it. So what are we doing? We're implementing this knowledge. Okay. We're trying to help you and I to be very, very smart and thoughtful and understand what's being said out there. Because the average taxpayer, the average voter, just hears the want, and doesn't necessarily understand what it is, okay? And if those of you that are old enough to know Charlie Brown, you know what want means, okay? So let's talk about an accredited investor. What is the role of accredited investors? For companies raising capital, the accredited investor definition largely determines who is in their pool of potential investors. Okay, so what is it? It's a pool of potential investors. Okay, these are companies that are raising capital. I'll get there in a second and explain what this means. And for investors, whether they are eligible to invest in many early stage companies, many of the offering exemptions under the federal securities law limit participation to accredited investors or contain restrictions on participation by non-accredited investors. Okay, that's all fine, Bob, but what does that mean? Well, let's look at the financial criteria of an accredited investor. Before we do that, how can individuals qualify as accredited? Well, good question. Individuals, natural persons, may qualify as accredited investors based on wealth and income thresholds, as well as other measures of financial sophistication. So what the government has done, what the Securities Exchange Commission has done, is they said, if you have a certain amount of money, whether it's sitting in the bank account, net worth, or an income stream, you are smart as a financial decision maker. Now, you and I both know that's not accurate, because it doesn't matter how much money you make or what your net worth is. You may not really understand the rules to investing, and you really may not make good business decisions. Why do I say this? Because we hear about lottery winners. We hear about professional athletes. We hear about actors. We hear about all these people who make lots of money and they make bad business financial decisions. Okay, but the government says, well, you've got the money to lose. Okay, and so they put them in this particular category. All right, but there's also rules to the groups that you're investing in. Okay, and it's a non-registered security. It's called a Regulation D. There's an entire regulation called Regulation D, private placement. Okay, meaning that it's not going to be on the stock market. You're not going to see it on Bloomberg. They're not going to talk about it on these financial notifications. You're not going to have Fortune or Kiplinger or Bloomberg or any of these guys reporting on these. These are private placement. What are you placing? You're placing a pool of investors' money, raising capital, into other investments. What are those investments? And there's a list of what those investments can be under Regulation D. So let's go back and talk about what is an accredited investor. Well, there's a financial criteria, net worth over $1 million, excluding a primary residence, individual or spouse or partner. Okay, so you need to have over $1 million, not including your personal residence. Okay, your income over $200,000 if you're an individual, or $300,000 with the spouse or partner in each of the prior 2 years, and reasonably expects the same for the current year. Now, income is different than taxable income. Okay, so you may be somebody that says, well, I don't, I make that, but I don't pay taxes on that because of various deductions, or that we may have businesses or whatever the case may be, but there's a distinction. Okay, now professional criteria. You could be an investment professional in good standing, holding general securities representative licenses, an investment advisor, Series 65, private securities offering representative, Series 82. These are all securities licensing numbers. Okay, so like if I was a life insurance licensed individual, it's life insurance license. But these are the license series of what these professionals are. You could be a director, executive officer, or general partner of the company selling the security. Any family client or family office that qualifies as an accredited investor. Okay, for investments in private fund, knowledgeable employees of the fund. There's your criteria. How can an entity qualify as, okay, so an entity qualify as accredited. Entities owning investments that exceed 5 million. Okay, assets, the following entities with assets over an excess of 5 million, such as a corporation, partnerships, LLCs, trusts, nonprofit organizations, employee benefit plans, family office, and family clients. All right. Owners as accredited. Entities where all entity owners are accredited. So this is a business that has all these types of people, accredited investors, as owners. An investment advisor, somebody who has those securities licenses, is considered accredited. And then financial entities, bank, savings, loan, association, insurance, registered investment, these are all considered accredited investors as well. All right. So that's based on the Securities Exchange Commission. This is their website. Okay. A definition. So what's a non-accredited investor? anybody that doesn't meet these criteria. Simple. Okay. Give you an example. It's so they were interviewing a FBI agent, and they were asking the FBI agent, well, with all the counterfeiting, he was in the counterfeiting division. So with all the counterfeiting of money, how do you guys train on all the counterfeits? It's crazy to know all the different ways that the paper money, United States paper money, could be copied, faked. And so how do you guys train that? And it was a very simple answer. The answer was, well, we don't learn all those. We just learn what the design of our dollars look like, the actual dollar. If it's anything that's different, then it's fraudulent. Okay, well, that makes a lot of sense. So if a accredited investor, these are the guidelines, anything that doesn't meet these guidelines is not an accredited investor. Plain and simple, right? So, all right. So now what we want to do is we want to go into this article. So that's some guidelines and some baseline. And let's go into this article and talk about this article. Now, the IRS plans to go after complex partnerships to close vulnerable tax gaps. Okay, well, let's see what they're talking about. The Internal Revenue Service is planning to address what it calls large, complex partnerships in attempt to go after business entities that avoid paying taxes by abusing known loopholes. Okay, what's this? Partnerships? Let's go back to the back to this. Partnerships does not pay income tax. Right here on the website of the IRS, does not pay income tax. So what are they saying? They want to go after what? Large, complex partnerships and attempt to go after business entities that avoid paying taxes by abusing known loopholes. Well, you're going after an entity that doesn't pay taxes. No wonder you're not collecting taxes. They don't pay taxes. All right, well, let's keep going. Let's keep going. This would allow the agency to collect tens of billions of dollars that don't exist because they don't pay taxes and additional tax revenue via introducing double audits for partnerships with 10 million or more, not just one audit. We're going to double the audits by fiscal 2025 over fiscal 2021 levels, whatever that means. New research published by the Government Accountability Office, the GAO, found that the specific types of legal and commercial structures the IRS has been targeting needs to be better defined to recoup losses from uncollected funds. How do you collect something that doesn't create taxation at the partnership level? The GAO posted a list of 4 major recommendations to help the IRS to improve how it selects partnerships to audit for boosting compliance. Let's see what the recommendations are. I haven't seen this before. So let's see here. Okay. The Commissioner of the Internal Revenue Service should use representative sampling of partnership returns, including those in which IRS's current partnership models do not identify risk factors to help identify additional non-compliance that may not be detected to improve agency understanding the models. What? Okay. The IRS commissioner should validate the key assumptions used in IRS partnership models through analysis of data on audit outcomes or other research and develop a formal process for using audit results and other data. Okay. The commissioner should develop guidance defining large, complex. Yeah, there should be guidance on what you mean by this, the characteristics of these. That should actually be the first recommendation. Just saying. How do you do 1 and 2 without knowing 3? All right, just saying. The IRS should identify and implement measures for tracking progress toward agency objectives that reflect the definitions and guidance of large, complex partnerships. Okay, so that's what that says. All right, well, I guess those are good recommendations, right? So let's look at tax partnership loopholes. What do I said about loopholes? These are rules that are laid out that when they're not getting what they wanted, which, as you saw on the IRS website, says that they don't pay taxes, it passes through to the individual taxpayers, okay? Businesses have been increasingly organizing as partnerships to allow them to pass their income and losses onto their partners and to avoid being taxed as corporations. That's true, because they're not corporations. They're partnerships. And so I guess here comes another distinction. Okay. What's the difference between a corporation and a partnership? Well, you saw a partnership is a pass-through, right? And partners own a percentage based on dictating a what? The capital, the property, their skill, labor, right? Were some of the criteria of what a partner can have added to a partnership. Okay. And based on what the partnership agrees to is based on, I don't know, what they get as a percentage of ownership. Okay. A corporation is structured same. Instead, though, it is shares. The corporation dictates the number of shares, and based on the value of the business and the number of shares depends on the value of the share price. Okay. That's the basics of it. So if you have 100 shareholders and you have 100 partners, how many shares or partnership percentage does 100 partners get of 100%? Anywhere from 0 to 100. Okay. So when I say 0, I mean 0.0. Can a partner have 0.10? Absolutely. You don't have to have a round number of 1%. You can have a fraction of a percent. The same with ownership in shares of corporations. Okay. So it's just understanding the language and the rules that are laid out. So when we go back here and we look at this, it says businesses have increasingly organizing as partnerships to allow them to pass their income and losses onto their partners to avoid being taxed as a corporation, because they're not a corporation, they're a partnership. Okay. The IRS has not defined or developed guidance on what a large, complex partnership is developed, measured, or insured, because there is no requirement or limit on number of partners you can have in a partnership. Okay. You don't have a number of limits of shareholders. Now, you do with an S corporation, a subchapter S corporation, which is a pass-through. You can only have a maximum of 100 shareholders. A C corporation, which is what all the public traded companies are, you can have unlimited a number of partners, or I shouldn't say partners, sorry, shareholders. Okay. So these entity structures are there for a purpose. For a purpose. Okay. So this is one reason why large partnerships have surged in recent years as a commercial designation within the U.S. economy. That's their assumption. Businesses that register as partnerships do not pay taxes directly, but pass their tax liability onto their partners, through an IRS Form K-1. These companies can be hidden within other partnerships in networked or circular structures, making them very complex for auditors at the tax agency. So what the government allows as ownership of a partnership is not necessarily an individual, but a corporation or another entity can be a partner. Okay. So a trust can be a partner. A corporation, a natural person. Okay. That's the rules. You're allowed to do that. The lack of a definition presents challenge as an IRS seeks to increase the audit coverage of partnerships. Why are they seeking to increase audit coverage in partnerships? They don't pay taxes. Tax experts have long stated that partnerships were being abused as a potential dodge. Who tax experts? Who? This is what I go back to. The tax community globs onto loophole terminology. No loophole, following the rules laid out. Now, if they want to change the rules, then go change the rules, but don't call it a loophole when people are following what you created. People did not create it. They're not allowed to create this. You, as the government, created this. So if you don't like it, don't call it a loophole. Fix it. Amend the rule. The IRS does not treat K-1 income the same way that it does report people's wages on W-2 forms or the reports of income from dividends, interest, royalties, and contract jobs in the form of 1099. We know that, okay? The IRS computers match every wage, dividend, interest, royalty, and contract job report. Why? Why does the IRS computers track this? Why? Because that's what they told the computer to do. It's the IRS's garbage in, garbage out, right? Well, what form do people in partnerships use? Well, the tax form is a 1065, which the IRS lays out. And the report, the incomes, profits, or losses is called a K-1, which the IRS lays out. Well, change your freaking computers. Seems pretty simple. The IRS's differential administration treatment of partnership income is an example of what Treasury Secretary Janet Yellen has described as the United States two-tiered tax system. No, you created it. Why? Because you have accredited investors and non-accredited investors. You've structured things to where you can have a partnership, you can have a corporation. It all lays it out. In fact, the U.S. Government Accountability Office understands it too, because they're reporting recommendations on this. There's no two-tier tax system. There is a tax system that has been created. That's it. At the core of the problem is a discrepancy in ways types of incomes are reported to the IRS. Opaque income sources frequently avoid scrutiny, while wages and federal benefits are typically subject to nearly full compliance. Great. That's what you want. Large corporations increasingly get away with tax non-compliance. No, they don't. They don't. Over 80% of the IRS audits conducted on large partnerships failed to find any tax non-compliance on businesses registered as partnerships. Okay, so the IRS audits these things, these entities, these complex businesses, and over 80% are considered not that they consider they're good. They failed to find any tax non-compliance. Oh, because you think they should be paying more in taxes, that they're not doing something right. This suggests that the IRS did not choose the riskiest returns on audits or found it difficult to find non-compliance. Yeah, that's what an audit, my friends, is an examination. And what do you do with an examination? You have a right answer and a wrong answer. You pass or you fail. So this audit or examination sounds like these large partnerships have passed the examination when tested. Good for these partnerships. Around 84% of these entities report providing finance and insurance services or real estate or rental leasing. Okay, so these are companies, 84% of these entities reported are in the finance and insurance industry or real estate or rental leasing. These are in the industry that is governed by the Securities Exchange Commission. I don't know. Large corporation or large partnerships can be complex with income and business expenses passing through multiple levels, such as a partnership could be a partner in another partnership. That's true. And if you have accounting and you account a partnership, and from that partnership, information goes to the other partner or owner of that partnership, that accounting flows to that partnership accounts. It's just accounting that we have software that does that. The number of large partnerships with more than 100 million in assets or 100 or more partners has increased sixfold from 3,000 to 20,000 in 17 years. Well, good. That's very good. Why is that possible? Well, they see it as a bad thing. I see it as a good thing. What's happened since 2002 to now? We've had growth in the economy. We have people, our population has grown. We have a lot of businesses that have started. We have a lot of relationships. We don't do manufacturing here anymore. They're service-based businesses. So manufacturing corporations have left the United States, and you have service businesses that don't have necessarily a tangible product per se. They're services businesses. And so most services businesses do what? They create partnerships because you get multiple people together. Law firms, CPA firms, partnerships, doctors, partnerships, real estate investments, partnerships. Should I keep going down the line? They're all structured that way for a reason. The IRS audit rate for large partnerships has declined since 2007 to less than 0.5%, according to the GAO report. It shockingly found that 54 large partnerships out of more than 20,000 registered were audited by the IRS in 2019. Why is that shocking? A rate of 0.27%, just below the audit rate for those who made 25,000 per year or less. Meanwhile, the number of partners worth between $1 billion and $5 billion increased to over 1,000%. That's great. And 5 billion partnerships increased over 80%. That's great. That's great. That's growth. There's consolidation of partnerships. When one law firm joins another law firm, that increases the partnership. When a CPA firm buys out another CPA firm, it increases the partnership. When a doctor's office or a partnership merges or buys out another one, what happens? It increases the partnership. More than 80% of audits resulted in no change to the return. So why is this a problem? If you're auditing them and there's no change, what's the problem? I don't see a problem. IRS working to plug loophole. Okay. The IRS announced they were working on a plan to be more precise to define the large partnerships to solve the problem. We plan to perform additional research and analysis. Great. This is what you're going to use the $80 billion do. Is, hey, we're auditing these organizations. Think about this. We're auditing organizations. They're passing the audit, the examination, and we feel like they should be failing. So we're going to spend your $80 billion to figure out why they're not failing. Okay, that's really confusing to me. Really confusing to me. That actually sounds a bit criminal if you were to ask me, but no one's asking me. So I could keep going on. The tax gap expands to exploit high income. No, not really. Not really. It's just the natural progression. It's the natural progression of economics. It's a natural progression of the evolution. That's called inflation, right? The Federal Reserve has a 2% inflation goal, which means that if you use the rule of 72 and you take 2, divide it into 72, that means every 36 years, your dollar would be worth less than by half. So your dollar will now be worth 50 cents. Okay. So just by that thought process, I need double the revenue to make up for the dollar that was just cut in half. So because of inflation, it's automatically increasing the valuation. Things get more expensive. So partnerships are going to become more valuable. We know that. That's inflation. That's capitalism. That's the growth of an economy. That's mergers and acquisitions. It's the natural course of economics. And you as an entity who laid out the rules are organizing, doing testing, examinations, and people are passing the examination, and you're saying something has to be wrong. It's like a high school teacher or a college professor, everybody's getting a B or an A. Oh, something must be wrong with my test, or something's right. Maybe they're studying and learning. Maybe you're a good teacher. Oh, I got to make my exam harder so people fail. That makes zero sense. Oh, my employees, we're doing great. Our revenue's increasing. Oh, wait, my employees must be doing something wrong. We're doing too good. I need to create more rules to punish my employees and fire them and hire new ones. You see, this makes zero sense in any other area of our life. Car safety has increased. That is fantastic. Maybe we should have failing car tests, safety tests, so we can improve our safety numbers, right? That makes zero sense. Should I keep going? Right? My kids' potty training. They now go to the bathroom on the toilet every single time. They don't wet their underwear. Oh, maybe I should challenge them. Let's go on a road trip and not stop for 5 hours. Let's see what they do. Right? Zero sense. Makes zero sense. But what do all these partnerships do? They invest in the economy. And what does the economy do? Creates goods and services that are provided for the economy. So real estate, what's it do? Creates housing that the government clearly can't do. So it creates housing, living for people to, so people are leaving California in droves, and there's a lot of apartment complexes being built here in Texas. Well, don't buy apartment complexes. Let's not build them. Let's cancel those partnerships and people can live on the street. Well, tell me how that's working, LA, San Francisco, New York City. How's that working for you? Makes zero sense. So anyways, that is government. Welcome to the government conversation. Hey, if you like this content, give me a thumbs up, subscribe if you haven't subscribed. I appreciate your time. And I know this one was a bit long. I do apologize, but this is so important, what's being said and what's going on out there. And we just got to be aware of it. That's the job of our channel, is to make you aware of what's happening out there. So you and I can know how to address it, how to combat it. It is what it is, but that's okay. Lay out the rules, follow the rules, play by the rules, and you succeed. They'll change the rules again so they can get more out of you. But guess what? That's what's always happened. That's always happened since caveman and clubs and rocks to now. So just, it is what it is. It's a human evolution, if you call it evolution, progression, if you call it progression. But that's what we're here for, is to try as much as we can to help read between the lines and be a little more understanding of what's being said out there in the business world. Thanks, guys. Appreciate it. Bye-bye.